Welcome to the CRE with CBC Worldwide podcast, 2026 Outlook Edition. We recently released our 2026 Outlook report, and rather than just recap the data, we thought we'd have a real conversation about what we're actually seeing in the market, what's changing, what's steady, and what it all means heading into the year ahead. So I am with my boss and our fearless leader, Dan Spiegel. Welcome. I'm glad we're finally talking about this.
I'm glad to hear, Jenna. It's kind of funny to be on the other side of a podcast, but I look forward to it.
Exactly. And this is our first podcast together.
It's our first
funny
one
enough,
together.
two
We
hosts
do them
have their own
separately.
work.
Hopefully we have a lot of listeners out
Do
there.
we do them
We
separately?
do them separately, but this is our
A lot
first
of
together.
listeners.
It'll be fun. I think it's awesome.
I'm excited. Well, let's just kick things off. As we finalize the 2026 Outlook report, what felt most different compared to last year?
That's a great question because, it's only with time do you get perspective on a market. So we ended 2025, and I think 2025 was a year of up and down, and indecision I'll say in large part, I don't know. It started off pretty good. It went kind of flat mid-year, and it definitely was kind of flat in December. That said, we did start to see transaction volume and decisions picking up at the very, very end of the year in commercial real estate because the deal cycle is as long as it is relative to residential, for example. Those pickup in decisions and actions take several months before we start seeing transactions. So it was a pretty up and down last year. And frankly, I don't think this year is going to be a huge turnaround. I think the decision making, as I just mentioned, will start to lead to more transaction volume, but I certainly wouldn't predict it's going to be a big boom. Of course, it'll vary by asset class, it'll vary by geography, it'll vary by lender type. There's so many nuances in commercial real estate. I think we'll see an uptick overall compared to 25, but it's going to be a lot of variation between asset class and geography.
So if you had to describe today's market in a phrase or two, what would it be?
Boy, that's a tough question, Jenna. Today's market, I will say, how do I say this? It's sort of like positive caution. Is that fair? Is that one or two words? It's like I think people are feeling that transactions are going to happen, but there's still caution because I think the caution comes from just uncertainty in economic conditions. We have one day of good news about employment, and the next day, questionable news about something else, tariffs or whatever it may be. So that, in commercial real estate in particular, likes certainty or more certainty of economic conditions because you're making, substantial investments over multiple years. So you need to know, will I be able to raise rents? Will the demand come back? And all those things are dependent on economic variables, which, as we've experienced in recent years, and frankly always, are just not always certain. So I'd say positively positive caution. I think that's where I'm settling.
Yes, people are being thoughtful and selective. I assume a lot of that is because it's getting a little bit more expensive to borrow. Activity is up, transaction isn't. People are actually behaving with caution, as you just said. It's not uncertainty, discipline, something else. So why do deals feel so close right now, but while they're taking a little bit longer? Commercial deals do take longer, but why do
Yeah.
we feel like some of these commercial deals are still taking longer to cross the
Well, I
finish
think
line?
you hit on one variable, and that's cost of borrowing and availability of borrowing and lending conditions. So again, I'll contrast it to the residential market, which is sort of like where's the 30-year fixed rate? Yeah, that kind of changes demand. Commercial lending, first of all, is done on much more commonly done on short-term basis, so 3, 5 year loans, things like that. And at the end of those loan periods, I mean, you think that 5 years is long, but if you're doing a new development, it comes around pretty fast by the time you finish construction and lease up and so forth. Let's say it was multifamily. Conditions have changed, and that's something we're seeing. So, for example, multifamily deals that now in 21 may have been financed on, they'll call it 3% interest, something like that on the commercial side, are now coming due. And to refinance them, they're facing 7 or 8% interest. And they have to make a decision, does the value and the rents that they've, demanded over that period of time justify? Do they have the cash? Do they have to have an equity call? Or do they have to give it back to the lender? So one key thing is just cost of borrowing. Lenders have also been a lot more strict when it comes to borrowing, and looking for, more equity in the deal and so forth, and just not willing to take the risks that they might have back in 22, let's say. So that's uncertainty, and all that just leads itself to longer, slower decision making, right? Because you gotta put together maybe different finance partners or turn to different lenders, or potentially the property goes back or it doesn't go back, or the lender says, hey, I'll give you another 6 months to figure it out. All those things just extend the deal cycle.
And yes, capital discipline is consistent across the board. And I want to go into a little bit more of each of the asset classes. You touched on multifamily a little bit, still benefiting from, structural housing demand, but capital is more disciplined around rent growth assumptions and new supply. What else should we be watching with multifamily?
So multifamily says actually one of the more interesting. I'm glad you started with that. It's an interesting asset class right now because there's a lot of variation around the country. Where during the I know it's 5 years ago, during the early COVID era, pandemic era, there was a big shift in where people desired to live. A lot of people moved to call it the Smile States, right? That's Texas, Sun Belt, Florida, and so forth. That smile across the bottom of the country, that is. And with that came a lot of construction. So what today we're facing in markets like Austin, Atlanta, some parts of the Southeast is way oversupply when it comes to multifamily, and hence downward pressure on rents and upward pressure on vacancy and concessions like free rent and whatnot. But truthfully, those markets will adjust. They just have to catch up. Remember, construction takes multiple years. So the decisions and permits that
Mhm.
were pulled and approved back in 22 are just coming on the market now. It'll take, a year and a half, whatever, to lease that up. And obviously in today's world, they're constructing less and that'll balance out. So that's one market. So one market's those Sun Belt or Smile States, where there's sort of oversupply and sort of downward pressure on rents, but I think it's going to be short term. On the other side of the equation, you have, I'll call them, I don't know what the opposite of the smile markets is. We'll call them northern markets. I don't know. But just where construction's been a lot
Yeah.
more conservative and constrained. So you and I are here in Chicago. So here's a good example. There has not been a lot of multifamily construction, and there is a lot of upward pressure on rents. Frankly, you can just look at the news headlines. Anywhere where they're proposing, rental caps or whatever regulation is generally a market where there hasn't been enough supply. So in these markets, frankly, investors going, wow, this is a place I want to invest because I can see upside on rents over the next couple years. So just a different dynamic, right? Just simply because the supply has varied. So definitely geography comes into play with multifamily. To your point earlier, the continued affordability issues that everyone hears about in the housing market has driven multifamily because if you can't afford to buy, you're gonna rent longer. It is what it is, right? There could be apartment rentals, it could be single family rentals, that's a different type of asset, and so forth. But, the demographics, so to speak, at least in the near term, are for pretty good demand, in the rental market space. And then in the markets where there's not oversupply, rents are going up. In the markets where there is oversupply, it'll just take some time to get to new equilibrium. All right. That's it for apartments, I think.
Multifamily, yeah. New development is slower. Refinancing is expensive. Buyers are sensitive to rent anywhere. Um, let's see. So we moved on from retail. What if we wanted to talk a little bit about office?
Okay, let's talk about office. Okay, office is another tale of two cities, if you will. I mean, I think every listener will probably be cognizant of the fact that the office market is generally challenged. It's been the case since the beginning of the pandemic when people started working at home. Now today you have the AI boom, which may result in fewer office workers. So you have a lot of pressure on downtown markets, maybe with a slight exception for New York and San Francisco, where there's been a lot of technology demand in office space. But by and large, office buildings are under a lot of pressure simply because there's not enough demand to occupy them. Now, the best office buildings, the Class A buildings, have demand because if you're going to rent space and you're going to rent less, people are saying like, "Hey, I'll go to the nicer buildings." So where there's a lot of challenge, it's in the what we would call Class B or maybe Class C markets, property types rather, that maybe were constructed in the 1980s or 1990s, don't have the amenities, the standards that other Class A buildings have today, locational advantages. Maybe they're in a suburban office park where people just that's not attractive for workers today. Maybe there hasn't been a lot of capital improvement. There's a lot of challenge in that sector. And unfortunately, I don't have an easy answer to that. You can't wave a wand and convert to multiple apartments. It's not that easy. It doesn't happen that way.
No, can't.
So we're
Mm-mm.
just gonna have to deal with it. Some of them will be raised and turned into other things. Maybe it'll be turned into different kinds of housing. There could be an opportunity as I mentioned, New York and San Francisco, two urban markets that are showing some comeback, but it's going to be a haul. It's going to be a haul. There is definitely some opportunity in office because I don't think demand's going to get worse. So there is still demand for office space. Question is, where's the asset? Is it in good leasable condition and so forth? So, tale of two cities in office.
Yeah, the older buildings without those upgrades are really struggling. And I also, the tenants want that smaller, high quality space. And to your point
Correct.
on the Class A doing better of those mixed areas that people
Yep.
are really going for. And also, I think lenders are also looking for more consistent tenants
Well,
as
don't forget
well, and making
employees.
sure that there's that longevity.
Let's not
Yeah.
report the employee. If you wanna get if you're a company that believes in office work, and you wanna get people back into the office, and you gotta make their environment super cool or attractive or convenient to access or whatever it may be that drives your particular workforce, that's an important factor. So, companies that are trying to get people back to work or feel like that's their competitive advantage, they need to be in nicer buildings, both because right now it's economically not a bad deal, but also because they wanna make the workplace attractive.
Let's transition now to retail because that kind of feels bifurcated a little bit. Like the capital is selective, but um, necessity driven centers are attracting disciplined
Yep.
capital there. Where are you seeing retail going?
It's interesting, Jenny. Going back to what you asked me at the beginning about the words, what did I say? Optimistic caution or something like that at the beginning. Yeah, it's something,
Yes.
and it's because just about every asset class has there's a good side here and there's maybe a not so good side here. So on the retail side, similar dynamics. Retail, I kind of laugh and smile every time I think about retail because go back to the pandemic, everyone was like, retail's over. No one's going to go in stores. We're all going to buy everything in Amazon, blah, blah, blah. Okay. So yeah, we still do. We buy a lot of stuff online, it's delivery, but people are consumers, I should say. There is a demand for being, that in retail experience. People do wanna feel and see goods. I know when my wife and I sometimes are looking for things, like, I want the convenience of actually seeing it and making a decision rather than buying a bunch of stuff and having to ship it back. So, I think there's some backlash to
Yeah.
online shopping. Certainly, there's a convenience that's not going away. So that's one thing about retail. The other thing about retail, experiential retail, there's been a lot written about it, said about it, but people want to be in places together, right? The pandemic may be still in our subconscious or forefront of our minds, but people want to be out, they want to be in person. So that could be a restaurant experience, a food at live show experience, but it also could be an experience in a retail store, so to speak, or a retail, new concept or something like that. So there's some demand for that. I would say the soft part of retail, and there's retail, or one of the other issues of retail is it hasn't been overbuilt. So there's generally a good supply demand balance in most markets. I will give the exception of regional malls. I think everyone, probably has experience with malls in their marketplace that have gone belly up, have been raised or plan to be raised or have, very little traffic and so forth. Those just have to find a new life. It's just and that's more, that's a concept that, let's say, started in the 1970s that just has lost luster today. Now, there's still some malls around the country that are super packed, but we're just sort of over mauled, right? So again, it very much depends. Another two stories here of what kind of retail. And then the last, I'll give a third type of retail, which is downtown retail, urban shopping, for the same, as an adjunct to the conversation of office space. If there are not people working downtown, there's not people shopping downtown. So if you go to a downtown in most cities, you will see, unfortunately, not or just too little street life because people aren't there. Therefore, the restaurants aren't there, the shops aren't there, so on and so forth. And again, that won't come back until there are either people living or working in those downtown markets.
And you touched on industrial a little bit, so I want to go to that asset
Okay.
class next because you talked a little bit about industrial from the pandemic isn't in that hyper growth moment anymore, but structurally, e-commerce hasn't reversed. People are still buying things online. They
Absolutely.
still want them to ship quickly, but that means the distribution infrastructure still matters. So, what are you seeing as
Yeah,
industrial?
that's a now that one I will say there's not really a tale of two stories. There's one asset class where it's huge focus on construction of large warehouse distribution over the past, gosh, probably decade, maybe a little bit less. To facilitate, I can use Amazon as the best, but there's lots of other ones as well. These are companies that needed well located, large, what are called high cube distribution spaces. These are those concrete, what are called concrete tilt-up construction, just a concrete wall that's leaned upright, generally have 42-foot clearance. They may be facilitated by robots today, right? And certainly, it doesn't take as many people to operate a warehouse there once was. They have great access to highways. Perhaps they're near inland from shipping ports, or they're near rail, all those things. All right, so that was a big boom, particularly markets like Chicago, the Inland Empire in Southern California, and many other markets around the country where distribution is key. That market is pretty stable these days. I don't think we'll see a huge boom in additional construction, but where we did point out in the report, and let's go back to the fact that we did issue our 2026 outlook, is small industrial
Yep.
spaces. That is where there is a dearth of leasing space opportunities. There are not enough small spaces for either last mile distribution, as it's known, or for smaller business people or people who just don't need those large spaces. They need space. So I think there's an opportunity, certainly on the development side, in many markets, to build 100,000 square feet. However, it's going to be divided down, starting at 5,000, let's say, into separate suites and units. There's not enough of that supply in most markets. I know here in the Chicago area, some of the north suburbs, near north suburbs are being, spaces are being cleared. Lots are being cleared to build more of that kind of flexible, smaller industrial space because there is demand. But that exists around the country. So that's kind of a positive story. I'd say steady and with some upside too on the industrial side.
And we're still hearing, though, so across all of the asset classes, this isn't a lack of interest. It is really about that capital discipline, or that optimistic, uh, what did you call that again? Optimistic,
Caution.
selective, and thoughtful caution.
My
Yes,
optimistic
optimistic
caution.
caution. We'll get that. We'll get that. Optimistic caution. The money hasn't disappeared. They're just more intentional and thoughtful about where they're going with it. Is there any
Yeah, I
asset
mean,
class that
they're
surprised you
definitely.
most in our outlook report this week?
Yeah, there are other, there's other things in the outlook report. Maybe we can go into land
Yeah,
sales is
land. That's
really
me.
just a function of where development is going, because by and large, land is acquired for housing development or industrial development, things like that. Today, that segues into something we didn't really cover in the report, but maybe one of the big drivers of land sales is data centers. There's no doubt that data centers, which are required to facilitate the AI industry, they've been those parcels have been selling in many markets, but key markets like Northern Virginia is a key one for sure. Places where there's probably less environmental risk, there's steady power supply, there's steady water supply. There has been quite a rush to build data centers, A, because the AI boom is here. That's part of it. And then B, developers really saw an opportunity in a segment that didn't have a lot of supply to build out data centers. And they wanted to get a little bit ahead of it before, how do I say this? There started to be some community opposition. I saw an article actually just this morning about, hey, we'd rather have more homes than data centers. I get it. Land use is a hot topic in most parts of the country. So that'll be a challenge. But there's a number of people, the developers, that really wanted to get ahead of it, get those data center built. If tune to the press, you've seen some of the companies, Amazon and others, have even built power supplies, taken over jet power generating because they're concerned about having enough power for data centers. So this is really a segment that's sort of just beginning. We'll see where it goes. We'll see if it gets overbuilt. I'm not sure yet. I'm not an expert on, I think the other challenge in data centers is simply technology is changing super fast. So what's built today, it may not be the same demand in 3 years from now. That's what's really unknown in that space. We didn't cover that in the report, but I describe all that because it is somewhat behind the demand for land in a lot of markets around the country. So that's another one. There's a lot I could go on, Jetta. There's a lot of asset classes and subtypes of self-storage. Senior housing is another one that I don't know if we talked a lot about it, but I always tell people, the world's only, I shouldn't say the world, but I will say the population is only getting older. And that's, simply demographics. Baby boomers have reached retirement and moving into retirement, at least in the United States. And hence, age restricted communities, senior housing, assisted living, all that kind of stuff. There's some regulatory requirements to build that type of housing, or some of those types. So there's some flight restraints, but that'll be in demand. Adjunct to that, medical office, right? There was a time when everything was around the hospital. Now medical's a lot more distributed. There is a segment called medtail, which is the marriage of medical uses in retail centers. So that's like if you go to a doctor's appointment, it happens to be at a strip mall. or you go to a dialysis center in a strip mall, so on and so forth. Physiotherapy in a strip mall, that's MedTail. That wasn't the case 30 years ago. That's not where you went for those services. So that's been a pretty positive growth area because as people get older, there's another service that you have to deliver in person by and large, medical services. So there'll be demand for it. I could go on. There's a lot of things, and we do cover a variety of topics in the report. And there's dot and I will say it location depends on that. It also depends on demand. While I'm giving you some generalities for the market as a whole, in a local market, things could be very, very different.
Absolutely. And I know we can go into the subtypes, but I appreciate you covering over the ones that you did. And again, there's more in our Outlook report, some of those asset classes. If you're a broker listening to this at the moment, what should you be doing more of in 2026?
Yeah, listen, if I'm addressing a real estate professional, right, and I do all the time in our network, I would say, A, stay super close to your clients. Ask your clients lots of questions. Understand what's on their mind, right? Yeah, the role of a real estate professional, in my opinion, is to solve business problems with real estate. So a great commercial real estate professional asks a lot of questions with a client. What are their goals? What are their timelines? What are they challenged with? Instead of taking at face value, I need to, go to this type of building or that type of building. A good professional will say, let's sit down and really talk about what's going on in your business. Or if you're an investor, what your goals are. And then let's get to the real estate. Let's not just hop in the car and go tour things. Let's really understand because I think more times than not, a client, what's really on their mind, what's really bothering them in their business, or what they may think they need is not necessarily what they end up with. So a good real estate professional really is a good listener and a good question asker. Is there a term for that? Inquisitive, to understand the goals of the client. Yeah, that takes them into the market. So that's one. Look for opportunities. The value of a commercial real estate professional is those insights, right? There's a lot of data out there. Certainly now with AI, you can go ask tons of questions when it comes to lease structures, availability, and so forth. But remember, that's pulling from a lot of publicly available resources. And I'm sure there's great answers. But nuance is important. That particular owner of a building, a real estate professional will know the nuance. Well, that owner is dealing with maybe debt on the property or they're looking to sell in a few months. That's not going to come up through AI. Or there's a new construction development next door that you heard about being proposed, right? Those are all insights that a professional has. So, and a professional should always be cognizant of providing insights and advice to their clients because that is their job. Clients make the ultimate decision. Real estate professional does not, but their job is to advise and inform, and those make the best long-term clients for a broker for sure.
We always say it is a relationship business. And to your
Right.
point, AI is not going to have that information that it can't find anywhere on the interweb. And it always wants to make you happy first and then give you good information second. So we always want to make sure you're doing your due diligence and following up with that data. But you definitely need someone that actually knows the neighborhood, the expertise to be able to advise on that. Is there anything that you think in the market right now or in the trends that people are misreading in terms of where the market is going?
Oh boy. I'm it's easy to be a prognosticator and it's also not easy. Because the market dynamics change all the time. As I said last year, you would ask me the conversation in January. I probably did record a podcast. I can't recall. I would have been pretty bullish on 25, and then things went flat. But don't forget, there was Liberation Day. I can't remember what it was even now, right? That put a lot of uncertainty in the market. Then there was questions about who's going to lead the Federal Reserve, so on and so forth. Doesn't really matter. That uncertainty, unfortunately, kind of freezes the market and freezes decision making, I should say. People just put it on hold until they wait and see what happens. So, barring that, barring that I don't know what surprises around the corner, I think, as I said earlier, and we talked about, I think this year will be a better year than 25 overall for transaction volume. I think we are going to see more decision making. I don't think we're going to see a lot of cap rate compression or anything like that. I think markets and pricing will be pretty steady. You can go to MSCI or Green Street, and we cite some of those sources in our report as well. But pricing's come down. I mean, it has come down in general, across the country. And I don't think it personally across asset classes, I don't believe it's going down further. I'm going to say that as a little bit of a generality, but across the board, I think we've seen that. and we've already started to see some uptick in pricing in particular assets in particular markets. So I'm going to be cautiously optimistic, like a little bit different phrasing than I used earlier. But, I just feel like this year's going to be better. Decisions are going to be made, barring those surprises that you and I do not know about at this moment. I think this will be a better year. I think it'll be a better year. I think we'll see more transaction volume. We did at the end of last year. One place we did see transaction volume was in the big cities. So New York and San Francisco, a
Mhm.
couple examples I gave. As people came back to work, those two markets are heavily tech driven now. And there started to be some trades. And to the point, if someone has been to New York, has been to Hudson Yards, for example, that's a pretty well leased development. And that's a newer development, right? To the point earlier, good quality office space, right location, there's a demand for it. So just pay attention to the nuances. There's a lot out there, but I'm going to say I'm pretty optimistic for improvement this year compared to last.
And when that transaction volume does return, who do you think will benefit the most this year?
You listen to the investors that can make good decisions and have good advisory, right? At the end of the day, it's somewhat of a generality to say, there's money to be made everywhere, but there truly is, right? It doesn't matter if your market's going up or down. The best investors and the best users of space really just make insightful, informed decisions, um, hopefully a little bit ahead of the curve. Look at the fundamentals, look at the demand. Don't just look at the price, right? The price isn't only the determinant. Back to the conversation about multifamily, right? You look at where the demand is in the market, right? You could pick a market like you and I are in where it's not the economic growing as fast as the Sun Belt markets, but there hasn't been a lot of supply in multifamily. So you got to understand all those nuances. But those people who do study, get good advisory services from commercial real estate professionals should certainly benefit and do well.
And I promised you at my Women of Coldwell Banker Commercial podcast, I have a lightning round. I promised you I wouldn't throw
Thank you.
some random questions on you. So, are there any final thoughts on the Outlook report that you would like to share
Well, seriously,
with our audience before we wrap
yeah.
up?
Yeah, thank you for that because I like listening to lightning rounds. I'm always super curious how people answer them, but I wasn't prepared. Or, to me, I wanted to think about it. But anyway, so aside that, so first of all, where do you get the forecast reports? You go to www.cbcworldwide.com, our brand website, and I think it's Insights, right? I think that's what it's called, if I remember right. And you'll be able to download
Viewpoint.
viewpoints. I'm sorry, viewpoints. Sorry about that. But you'll be able to download it from there, free to anybody who wants to download it. So that's something we always do a mid-year outlook. So be ready coming about July. We'll talk about where we are in the year, and we can go back to this recording and see how accurate I was or not. But that's one thing. Other than that, I think it's just there's opportunity. Don't I would encourage listeners to really not, listen to the news, pay attention to the economic variables, but you just make good, sound decisions, right? There are decisions, there are good opportunities to invest, and to own and to lease across the board. Just make well-informed decisions. Get the right information, think about your business, think about your objectives, and make decisions. Don't give in to your perception of headlines. Headlines will always be there. There will always be something new tomorrow, but that doesn't change fundamentals. And don't forget, real estate's a hard asset. So the stock market is super frothy these days, right? No one knows where it's going to end, if it'll end, whatever. But there is sort of a demand and a preference for real estate these days because it is a hard asset, right? And as I said, we've already taken the hit from the peak in 2022. So that should be driving capital into real estate for investors, certainly compared to equities. So those are some thoughts for this year.
Well, thank you, Dan. This was such a great conversation. We're cautiously optimistic going into this year. Stay tuned for our mid-year report, as Dan mentioned, that will be coming out in July. I think for right now, what stands out most is that the market isn't stalled right now. It's just being a little bit more intentional, and that requires a different kind of leadership and perspective. So thank you all for listening today. Again, go to our website, cbcworldwide.com, download the full 2026 Outlook report. It's designed to be a practical resource for you as you navigate the year ahead. Dan, thank you for the conversation today. It's our first of many podcasts together, and thank you everyone to listening to CRE with CBC Worldwide. We'll see you
Thanks
next
for
time.
having me as a guest, which is a very funny thing to say since I'm leading the brand, and I host podcasts. But thanks for having me as a
Your own
guest
podcast.
because I don't always get to talk about it in the way our guests do. So it's a fun conversation, Jenna. I look forward to having it again, perhaps in the mid-year.
Fantastic. This was great. Thank you, Dan, and thank you, everyone. Until next time.